So today we are looking at valuation of target companies. Valuation of target companies. Valuation in M&A, in mergers and what year? Acquisitions. Valuation of target companies in mergers and acquisitions. Valuation of target companies in mergers and acquisitions. So there are various methods that you could make use of. Number one, you could use discounted cash flow method. Discounted cash flow method. That is number one. Number two, ladies and gentlemen, you could make use of what we call the PE ratio or a PE multiple. Number three, you could make use of what we call earnings yield method. Earnings yield method. Earnings yield method. Earnings yield method. We have number four, exchange ratio method. Exchange ratio method. Exchange ratio method. Yeah, book value method. Talk of net book value. Net book value method. ETC, there are so many of them. 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 And we shall start, ladies and gentlemen, with this question that was tested on April 2024. Question number 3, boy. Question number 3, boy. April 2024, question number 3, boy. Once you get this question, can you kindly say why for yes? Why for yes? April 2024, question number 3, boy. April 2024, question number 3, boy. April 2024, question number 3, boy. Have we gotten the question? Online ninjas, have we gotten this question? At least one student called admin has said why for yes. Thank you. So then straight away we read Duet Limited is considering a takeover bid for Small Limited, another company in the same industry. Small Limited is expecting to have earnings next year of 129 million. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. So you can see years 1, 2, 3, yeah? And then we have sales, etc. Additional information. From years 4 onwards, it is expected that the annual cash flows from Small Limited will increase by 4% each year in perpetuity. Tax is payable at the rate of 30%. Tax is paid in the same year it falls due. 3, if Duet Limited acquires Small Limited, it estimates that the gearing after acquisition will be 35%, measured as the value of its debt capital as a proportion of its total equity plus debt. 4, the cost of debt is 7.4% before tax. Duet Limited has an equity beta of 1.6. Number 5, the risk-free rate of return is 6% and the return on the market portfolio is 11%. So 1, the offer price for Small Limited, assuming Duet Limited chooses to value Small on forward price earnings multiple over how many times? 8 times. This one here, PE ratio. So in this case here, let's go ahead and value Duet using PE ratio method. So number one, value of Duet using PE ratio method. value of duet using PE ratio method. Now, when we talk of PE, what comes to our mind? It's price to what? Yes, somebody to earnings. And then, of course, ladies and gentlemen, this PE ratio, yeah, from what you're able to see here, it will be market price per share over what? Yes, somebody? Earnings per share. Please write like that. PE ratio equals MPS all over EPS. So they want us to value an organization. We shall always look at how we value a share. So make MPS the subject of the formula. Make MPS the subject. Make MPS the subject of the formula, abracadabra. So if you make MPS the subject of the formula, then MPS will be equal to PE ratio times who? Times EPS. MPS is market price per share. MPS is market price per share. Market price per share. You see, I don't want to just value one share. I want to value whole organization that has got many number of shares. So then to value the whole organization, so what we call firm value, using this approach, you will take the PE ratio times, of course, now this is the earnings per share, but now if it's the whole firm, we talk about what your total earnings. So this is the only thing you'll be required to remember. You don't have to derive the formula. Whenever you hear that, hey, you should value an organization using PE ratio method, always take the PE ratio times the total earnings of that firm. So in this question, have they given us the PE ratio? Have they given us the PE ratio? In this question, yeah, it is how many times? 8 times. They've told us 8 times, isn't it? William alone. In the question, the PE ratio or PE multiple is 8 times. How about the total earnings of duet? Remember, I'm valuing these using future earnings. So total earnings of duet, somebody who can talk to me? Somebody who can talk to me? It is hidden on the very first paragraph. It is hidden on the very first paragraph. On top there, madam, where we are starting reading the question, Duet Limited is considering a takeover bid for Small Limited, another company in the same industry. We did change this. We were valuing, in this case, Duet. You see, Duet is the one that is acquiring. Yeah, we are valuing the target. It's supposed to be valuation of what? Yeah, somebody small? Small. Yeah. Small Limited is expected to have earnings next year of how much? So then you take the PE ratio times the earnings you're expecting. So times 129 million, and then you are able to get your amount. How much are we looking at, abracadabra? How much are we looking at, abracadabra? At the very top, paragraph number 1, where we start reading the question, Duet Limited is considering taking over Small Limited, another company in the same industry. Small Limited is expected to have earnings next year of, are you able to see that? Yeah. You see, at times the whatever you're looking for does not have to be deep inside. No. Yeah. So we're getting 1032 million. 1032 million. Thank you so much. So the online ninjas, have they been able to follow up to here? The online ninjas, have they been able to follow up to here by any chance? Please feel free to always ask questions. Always ask questions. In my class, there is no stupid question. In my class, 8 times is given in the required. The offer price for Small Limited, assuming Duet Limited chooses to value Small Limited on a forward price earnings multiple of 8 times. Yeah, of 8 times. Which question are we doing? We are doing April 2024. April 2024. April 2024. Question number 3B. Question number 3, boy. April 2024, question number 3, boy. Like that. Great. So shall I continue now? So we go straight away to number two. Number two, they want us to give them the cost of capital of 𝐷𝐿 Limited. Cost of capital of 𝐷𝐿 Limited. So cost of capital, we are using the famous worker curve. We are using the famous worker curve. We're using the famous worker curve. So we are using the famous, so you write here, cost of capital. We are using the famous what here, somebody? Worker curve. Worker curve is a professional way of pronouncing it. Yeah, I want you to be pronouncing this as WACC, which stands for what here, somebody? Weighted average cost of capital. Do you remember the formula? So this weighted average cost of capital, the weighted average cost of capital will be weight of equity, cost of equity. Weight of debt, cost of, but cost of debt must be after who? Must be after taxation. Cost of debt must be after taxation. These people, they have given me abracadabra. They have given me the gearing ratio. Are you able to see the gearing ratio in this question? They have given me the gearing ratio. There is a place, if you look at note 3, if 𝐷𝐿 Limited acquires small, it estimates that the gearing after acquisition will be what here? Yeah. You see, gearing ratio is the same as debt ratio. Yeah. And they're telling me that this is 0.2 what here, somebody? Yeah, you see, gearing ratio, debt ratio is the same as weight of what here? Weight of debt. Is the same as weight of debt. Is the same as weight of debt. So then, having gotten weight of debt, what do you think will be the weight of equity? 0.65. Because you see, it will be 1 minus 0.35, isn't it? Which gives us 0.65 like that. So in this question, by any chance, have they given me cost of debt? In this question, by any chance, have they given me cost of debt? KD, look at note number 4. It is 7.4%. 7.4%. And they are very, very categorical. Before what here, somebody? Before tax. If I'm the one who was setting this, I would have said after tax. And you see, when I say after tax, I'm so sure I will be able to catch some of the students. Because even when you tell them after tax, they'll still go ahead and they say 7.4 times 0.7. You catch them. A good examiner should always have an objective of catching still. You catch them red-handed. But now you guys are quite aware of that. If it's after tax, you don't adjust for tax again, isn't it? Thank you so much. Now the next one, this examiner never gave us cost of equity directly. He never gave us cost of equity directly. But I'm a bright chap. Already I'm seeing some language there talking about risk-free rate. So when I see some language talking about risk-free rate, me as a bright chap, what KAPEM? No, nasoma sana, which is very, very good. Thank you so much. So when you see risk-free, blah, 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 you know they want us to use KAPEM to get cost of what here? Cost of equity. They want us to use KAPEM to get cost of equity. But now do you remember the formula of KAPEM? Risk what here? Risk-free plus of the market, isn't it? Minus multiplied by beta. Here now we talk of beta equity because we are getting cost of equity. Cost of equity. So now substitute, please. The ball is yours. The ball is yours. The ball is yours. Now the online students today, I'm not seeing you really responding to my questions very, very well as you do. And I know the problem. I told you, don't struggle with this subject a lot. Be doing the things that I normally teach in a class alone. You're not doing any research. I don't think there is somebody who would want to become a professor here. Would you want to become a professor? When most professors are outside here complaining that the salaries they're getting are not enough. I mean, the point is always repeat whatever we do in a class here, and you'll become a superstar. Yeah, you'll become a superstar. Before you start doing other questions, even from your past papers, always repeat, you can never go wrong. Never, ever. Just a pass. So now somebody is substituting their KAPEM cost of equity So the risk-free, ladies and gentlemen, risk-free rate in this particular question is how much? 6%. Even this girl is really revising this paper, which is very good. So 6% is our risk-free rate. It's given on note number 5, risk-free rate, and then we have return on market portfolio. You see, return on market portfolio is this expected return of the market, isn't it? Which is what there? 11%. So 11% minus 6% multiplied by beta equity. You can see beta equity beta is 1 point what here, somebody? 1.6. And then once you reach here, you'll again get some students, in this case, you're getting it wrong. You simply take your calculator and say 6 plus, open brackets, 11 minus 6 close, times 1.6, isn't it? So J, yeah, my youngest son is called Junior Joshua. So because they don't want to call him Joshua in the house, they may bring conflicts. They call him J. So is there somebody who's getting 14%? 14%. So let's go back to this Wakaka thing. So you can write there that our WACC, you write the formula again. Keep on writing it 100 times. So we are saying that Wakaka equals weight of equity. Do we have weight of equity? 0.65. Do we have cost of equity? It is 14%. 14%. Weight of debt is 0.35 times cost of debt, which is 7.4%. Then 0.7. I'm 100% sure that they haven't seen where I'm getting this 0.7 from. It's 1 minus T. Karibu sana. It is 1 minus T. 1 minus tax. It is 1 minus tax. So then our WACC at the end of the day will end up giving us how much? So according to the Chelsea, it is 10.913. It is 10.913%. So remember, 0.7 is 1 minus tax. You see, they have told me tax is 30%. They have told me tax is 30%. So have we finished doing the question? Cost of capital. These are a firm that has got both debt and what here? Equity. So I had to get what we call WACC. The online students, are they able to follow now? Are we together? The online students, are we now together? All right. Thank you so much. Thank you for catching up. Now, before we proceed, I would want to know, because I know there is an AFR online class which is ongoing. Does it mean that this number that I'm seeing here, they are skiving AFR? Does it mean that this number is skiving AFR? Or are you doing AFM alone? Are you doing AFM alone? Or have you moved there? Oh, AMA and AFM, okay. Oh, you are morning, then great. Last sitting, great. We are overcoming, great. Morning, yeah, that's what many students did. They went for the morning session for them to be able to get this particular session for you to really revise. So now look at Roman 3. So Roman 3, they want us to give them the offer price for small using discounted cash flow method. 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 Actually, they are free cash flows, not a problem. So first of all, give us the free cash flow schedule. So then what we have here? We have years 1, 2, 3. So we have sales. So sales. We can cut these zeros to, no, let's just work with them the way they are. So 300,000. Number 2 for 20,000. Number 3 for 80,000. we less cash expenses. So cash expenses, we have 180,000. We have 240,000. Then we have 270,000. Capital allowances in AFM, we don't call them capital allowances, we call them depreciation. So whenever you see capital allowances, please, these will be depreciation. Always, whenever you see capital allowances, we shall call them depreciation. So depreciation, what do we have here? 30, 45. 45,000. And then lastly, we have here 60,000, isn't it? Yeah. And then we have interest. Interest, we have 15,000. Yeah. Do we have any other expense? No. That next item called cash flow to replace assets. That is not an expenditure for our company. That one will be able to take care of it later when you're getting free cash flows. So subtract. So remember, there is this school of finance which says that interest should never be deducted whenever you're getting NPV. Because you see, interest is in the cost of capital. Interest is in the cost of, but that is neither here nor there. You can work this out anyhowly, but for us, we shall be subtracting interest. So then, are you able to give me profit before tax? Profit before tax. So like year one, I have 300,000 minus 180,000 minus 30,000 minus 15,000. Please give me an answer. I write. So I can see Elizabeth Ivaya. I can see Felix. I can see Stella. So you're getting 75,000 here. Thank you so much. Then go to year number 2. 420 minus 240 minus 45 minus 15,000. How much do we have there? Everybody should be really on their calculators. So J, my son, 120,000. 120,000. And then we have year number 3. Year number 3. Give me figures, please. 135,000. After we get these figures, what should we do next? We share this with the taxman. Taxman must eat something. Let's tax. What is the rate of tax given? It is 30%, isn't it? Rate of tax given is 30%. So you say 0.3 times this figure. Give me an answer. 0.3 times 120. 0.3 times 135. Give me figures now. Fly with those figures. Fly with those figures. So 0.3 times 75,000. Susan gives me 22,500, right? Thank you. 36,000. 4,500. Thank you so much. So you subtract these ones for you to be able to give us the part, the profit after tax. Profit after tax. We have a ninja called Lincoln giving me 52,500. Perhaps I should give an incentive, right? 52,500. 84,000. And then lastly, 94,500, right? So 94,500. So then once I get these numbers, what should I do? I want cash flows. I should come back and add tax. No, depreciation. Add back. Yeah, depreciation, isn't it? Add back, depreciation. The capital, and that's why I told you, please, whenever you see capital allowance, it doesn't sound very well for us in finance. In finance, capital allowance is depreciation. So you add back depreciation. Depreciation of what year? 30,000, 45,000, 60,000. So come here and give me the operational cash flows. So the operational cash flows you're adding back according to Wanjiko, 82,500, 82,500, 129,000, 129,000. And then lastly, what do we have there lastly? 154,500. Now, because of the size of my board, I will have to rub this and then I continue. So don't rub yours. You're continuing with your table. You are pretty much continuing with your table. So we have operational cash flows. So operational cash flows, the first one is 82,500. Then we have 129,000. Then we have 154,500. Yeah. You see now, this is what our assets are able to generate as cash flows. But we can't pay ourselves all this money as dividends. We'll still need to preserve some money within. So how do we preserve some money? Yeah. Invest in long-term assets. So in this case, you'll be able to come and say less CapEx. Less CapEx. CapEx stands for capital expenditure. Because, I mean, if you get all the cash flows and you don't buy long-term assets, then what is going to happen? The firm's longevity will be affected. So please write there CapEx. You know, right now you can understand it, but for revision in future, you need to mention there CapEx is capital expenditure. What is to be reserved? Cash reserved. Cash flow reserved for future expansion. For future expansion. And of course, acquisition of long-term assets. Are you able to see them? Are you able to see those cash flows which are to be reserved? Oh, yes. Year number one, it is 37 what year? 37,500, yes. And then we have here 45,000. And then we have here 52,050, like that. So then by doing that, now we'll be able to get what we call free atoms, free cash flows. 52,500, sorry for that. 52,500, sorry for that. Yeah. So they're able to get what we call the free cash flow. Mandela free. Mandela is free. So you give us the free cash flows. 45,000, It can't be one. Did you add? 45,000, isn't it? 45,000, and then the next one. 84, 84,000, and then the next one. 102,000. 102,000. And please, if you have somebody who has been failing this AFM for so long, for example, somebody who has failed it for 7 times, and ensure that they join this class. Even if they are in other classes, bring them here. Tell them they need to be joining this class on Mondays, Tuesdays, and the Sundays at what time? 7. I normally don't miss my classes. Last time I missed. Unfortunately, I only told the evening online students. I forgot to pass a word to you. Yeah, but this Sunday at exactly 7 a.m., I will be live, but will be online, right? We agreed. So once I get this free cash flow, now from there, what do we do? The Gachagua thing. You discount? Discount. So discounting, I leave that for you. Which cost of capital will you use? The Wakaka. Remember the Wakaka? That's what you use. And then again, remember, I've taught this thing for so long. I know some students will come and just discount this, and then they say now the firm value is the sum of the 3. Forgetting that from note number 1. Note number 1, they told us from year 4 onwards, it's expected that the annual cash flows from small limited will increase by what? Are you able to see that concept of perpetuity? So you need to find something here, 3. So now from 4, so you need to value this using the Gachagua model, which I will give you exactly 10 minutes to try this. Yeah, this was the same. What about our normal AMA class? You see, sorry for that, just 1 minute. Stop recording. All right. So, ladies and gentlemen, the first thing that we need to do, because they have given us the concept of a growth rate of our free cash flows after what year? Year 3. Year 3. So, which will go to perpetuity. So, we must calculate the perpetual cash flows. Yeah. So, they have told us note number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by what, somebody? By 4%. By 4%. So in this case here, come somewhere here and calculate for us the perpetual cash flow, perpetuity cash flows. So these perpetuity cash flows, remember, this is what we use Gashagua's model, which is the same as what here PO. If you remember very well, we say DO into what here somebody? 1 plus G, isn't it? Yeah. All over what here somebody? Kenya minus government, KE, isn't it? But now remember, that is when you are valuing an ordinary share. When you are valuing a whole organization which has got debt and equity, we use what we call W what here somebody? Yes, it's not only cost of equity. Cost of equity is when you are doing share valuation. Otherwise, if it's firm valuation, we use WACC. Minus what here somebody? Minus G. So our current dividends, are you able to see our current dividends are these ones? Our most current dividends, which is our most current free cash flow, will be 102,000 into 1 plus G. G is the perpetual growth rate, which is what percentage? 4%, isn't it? So 0.04. All of our wakaka was 0.10913. The one we calculated up there. Minus our growth rate, which is 0.04. That's how we get our infinite cash flow. So is there somebody who can help Mwalimu with this infinite cash flow? Quite an ugly figure that I should write there. Quite an ugly figure that I should write here. 153. Who is now telling me the truth? Who is telling me the truth? Who is telling me the truth here? Please ask a question. So you see, you take 102,000 times 1.04. And then you say divided by, open brackets, for the denominator, isn't it? And remember, 4% is the same as 0.04. So you say 102,000 times 1.04 equals, whatever answer you get, you say divide by, open brackets, 0.10913 minus 0.04, you close brackets, and then you shall tell me how much are we getting. Aching says 151 something. Whitney, have you really divided? Have you divided by 0.10913 minus? Or do you want us to do it slowly? Maybe they want us to do it slowly. The first one should be 106, The top one, Somebody, 102,000 times 1.04. Inakuja 080. How about this minus this? Can somebody give me this? It will be 0.0546. 6913, Yeah, then can you kindly divide that? It's body mass, remember. It's body mass, remember. It's body mass, remember. So what figure are we able to get, my friends? 153, 153, 4500.22. Thank you so much. So this is the perpetuity cash flow. What do you think was making some of those students in this case here get wrong answers? Yeah, you can as well round it to 11%, but I mean, let's work with these things at the very minimum, 2 decimal places. 2 decimal places. Don't round off to a whole number. No, that's why we have calculators. So then from there, come and give me what we call present value interest factor. At what percentage? At 10.913%. PVIF. So remember, our formula PVIF is 1 plus R raised to negative n. So it will be 1.10913 raised to negative n. Yeah, please give me 4 decimal places of PVIF. 1.1, why? Because you see, this is 0.10913. So 1 plus this, it will be 1.10913 raised to negative n. So like now this one will be 1.10913 raised to negative 1. You give me 4 decimal places, I write here. So I have a ninja giving me 1996 here. 1996. How about this raised to negative 2? So raised to negative 2. Wrong. They're telling me wrong. So it's supposed to be 90. 16. Sorry for that. Thanks. 16. 16. How about the same, but now raised to negative 2? 4 decimal places. 8129. Anybody getting 8129? Oh, I'm alone, but I will overcome. Yeah, at least the online guys are confirming, many of them. Yeah, yeah. And then now we go to the third year. The third year, what do we have? 73 to 9. Oi, 73 to 9. Yeah, then what do you think of this factor for infinity? The same, isn't it? Yeah, we pick this one here. We just take it here. For infinity, we have 0.7329, like that. Then come here and they give us the present values. So remember to repeat this. Because you see, you can't tell me raised to negative infinity, eh? You can't tell me that. So then come here and they give me, yeah, or you can, if it's drop down, yes, if it's written 1, 2, 3, you drop down, but also you can drop it by the side. Instead of going to do a new table, it by the side. So then come here and they give us the present values or discounted cash flows. These ones here can be in 2 decimal places, eh? So like 45,000 times this, you give me a number, I write down. 40,572, right? 40,572. I'm alone, but I'm overcoming. Thank you so much. How about the second year? So you're taking it for 64, 68, 283, 68, 283. Please don't give me whole numbers. I can see 0.6. Thank you so much. Thank you so much. 0.6. And then we have 102,000 times 0.7329. 102,000 times 0.7329. 74. 755.8. Thank you so much. And then there is this huge figure now. There is this huge figure. Please read two digits. 1122 026.56. Thank you so much. And therefore, total farm value. Total farm value. Yeah, there is one which is wrong, right? 1124. 1124, eh? 1124. 615. 663. 0.52. And therefore, total farm value, now you add all things here. You add everything there. You add all the discounted cash flows to give us total farm value. to give us total farm value. You add up everything. So they're getting their Mutai 1142 something, right? Add the four numbers. You take this, plus this, plus this, plus that, and then you get the total farm value, which is 11, according to Bwana Mutai, 42, 99, 61. They have refused that Mutai. They are saying it is 1308, 246. $1308, 246 point something, isn't it? Yeah. So in this case, if you don't give me this money, I cannot sell the farm to you. I can't sell the farm to you. So long as you've gotten something that is close to that, perfect. Perfect. Now, with your permission, ladies and gentlemen, I will go to a different question, which is a nice question. August 2022, question number 2B. August 2022, question number 2, 2022, question number 2, boy. August 2022, question number 2, boy. They repeat these questions word by word. That is why I want later on, you have to repeat whatever we do here in class. You'll never go wrong. And then one thing you'll realize, AFM becomes sweeter as we go. Because already you've been able to till the hard ground. Chapters 1, 2, and 3, they're the toughest. But now moving forward, everything will fall in place without you knowing we shall be through with the syllabus. That is why even if you look at, for example, the evening class plus the early morning, we have over 500 students. But most of them have now called saying, Mwalimu, now we don't want to sit for exams. Yeah, because they looked at chapters 1, 2, and 3. No, this is the easiest paper. You love it. You love it. Why should you postpone when you know that very well there is a new syllabus which is ahead of us? And the new syllabus will be crazy. Crazy. They're going to change so many things. It's 2027, January. So if I were you, I would ensure that I just pass, clear everything, including BDA. Yeah, they repeated that same question on May 2016 question 4B. Yeah. They repeat these questions often. And we even know the ones that are going to be repeated. Not that we are examiners, but we predict. So August 2022, question number 2, B, Duet Limited. Are we there, ladies and gentlemen? Rona Hotel. Rona Hotel, are we there? Oi, the moment you get it, kindly tell me. Rona. You simply say yes. Thank you very much. So Rona Hotel Limited is currently evaluating a proposal to take over Duet Restaurant Limited. The board of directors of Rona Limited is in the process of making a proposal for acquisition of Duet Restaurant Limited, but first needs to place a value on the company. Rona Limited has gathered the following financial data. I can see the WACC is calculated for me. 12%. PE, 12 times. Shareholders' required rate of return is what here? 15%. Duet Limited, current dividends the payment is 2.7. Past 5 years dividend payment is given there. The current earnings per share is 3.7. Number of issued shares are 5 million. Additional information, it is estimated that the shareholders of Duet Restaurant Limited requires a rate of return of 10% higher than that of Rona Limited, owing to the higher level of risk associated with Duet Restaurant Limited's operations. Rona Restaurant estimates that the free cash flows from Duet Restaurant Limited at the end of the first year will be 2.5 million. This will grow at an annual rate of 5% for the first 4 years, after which the growth rate will revert to the historical earnings dividend growth rate in perpetuity. Rona Limited expects to raise 5 million at the end of year 2 by selling off hotels of Duet Limited that are surplus of its needs. So they want us to give them the value of 𝐷𝐷 Limited using the following valuation approaches. So we start with a price earnings ratio. Price earnings ratio. So this one is very easy. We say total value, total firm value equals what times what? You take the PE ratio, not MPS. Don't cram that approach, no. We said we take the PE ratio times what here, somebody? Total earnings. They could be futuristic, forward, etc. So in this question, are you able to see some PE ratio? Anybody who is able to see some PE ratio in this question? Susan says 12. Are you able to see 12 somewhere there? Yeah, so 12. How about the total earnings of the company to be bought? Total earnings of the company to be bought. Anybody who is able to see the total earnings of the company to be bought? Total earnings of 𝐷𝐷. Total earnings of 𝐷𝐷. Here the examiner wanted to hide something there. Yeah. So in this case, you will take earnings per share times number of ordinary what year, and currently, how much are they earning this 𝐷𝐷? Currently, are you able to see the EPS, current EPS? 3.7. Oh, these guys are not following. The online guys are not talking. 3.7, isn't it? And this is the most current earnings. So 3.7 times how many shares do they have in total? 5 million, yes. So long as you get total earnings, they could be current or even futuristic. The most current one is 3.7. If they wanted us to give them forward value using this PE ratio, I would have looked for earnings of next year. Yeah, this one here, they are silent. We shall use the most recent. So what is 3? By the way, where did I get the 5 million from? Note number 4. The number of issued ordinary shares are 5 million shares. So 3.7 times 5 million will end up giving me what figure? 3.7 times 5 million will end up giving me what figure? According to Chelsea, it is 2220. They have refused that one. 18.5 million. 18.5 million. I know Chelsea man wants me to get, so it will be 12, the PE ratio times 18.5 million. So please give me the final answer. Please give me the final answer. So according to Elizabeth Ivaya, it is 222. 222 million. I'm 100% sure that this one, everybody would have gotten this. Everyone would have gotten this. Nobody would have missed a mark there. Okay? If they repeat this question, you guys will be able to get this right. Okay, ladies and gentlemen. Now, with your permission, I will go to number 2. Number 2, they want us to use the DVM model. DVM model. Dividend valuation model. Dividend valuation model. Remember, dividend valuation model is this Gachagwa's model. You can imagine if Gachagua was still in government, he would want, in this case, the dividends for the shareholders here to grow, isn't it? That's but a joke. Don't take me seriously. I don't take this politics so seriously. I just want you to remember, whenever you hear about dividend valuation or dividend growth, yeah, you always remember about Gachagua, isn't it? And if it's Gachagua, how do we remember this Gachagwa's model? It's very easy. So if it's Gachagua, ladies and gentlemen, we know this guy was in the provincial administration. So PO, he was a district officer who grew in rank, because for you to become a provincial officer, you must grow in ranks as a DO. You go to district commissioner, etc. So he grew in ranks. And of course, in this case here, since he got out of government, it's like Kenya is operating without what here? Kenya without government, isn't it? I know we have government, but look at the energy that these guys have to put in place to check him. It's not easy. Nobody can write him off. But again, if you hate the guy, don't think that I like him. No, mine is just for learning purposes. I don't talk about politics at all. I even don't have a voter's card. Yeah. Because look at what is happening in Tanzania. Do you need to be a voter in Tanzania now. There's no democracy, isn't it? Yeah. Yeah. So in this case here, we have PO will be equal to DO into 1 plus G. You see, this examiner was very, very bright. He never gave students G, the growth rate. He never gave us G. He never gave us G. And I told you, my good sisters and brothers, no, my sons and daughters here, some of you are very young. I told you, whenever you see the examiner giving you dividend per share, many of them, he's not giving you flowers. He wants you to use those many dividends to be able to calculate what your growth rate. So like now he has given us 2017, 2018, 2019, 2020, 2021, and then we have 2022, which very many guys forget. This one, you need those inner eyes to see it. Is there somebody who is able to see 2022? I'm able to see it very, very clearly. So in this case here, 2017, what figure do we have there? 1.5 as DPS, isn't it? 1.5, and then next. 1.7 next. 2.3. And then lastly, 3.7. Are you able to see, ladies and gentlemen, where they are talking about current dividends? You see, we have number 2, the past 5 years dividends. The past 5 years. So they have given us here the current dividend. Don't forget that. Whenever the examiner puts current dividend as a separate note, he is able to always catch many students off guard, many. And that is why I want, if you call me after exams, don't comment about exam. Tell me, Mwalimu Kame, we eat nyama. But don't tell me that this exam was very easy. And then when exams results are out, they come like this. And then now you become my enemy because you will now not be calling me. Let's take other things outside there. All right. So remember the oldest, this will be our DO, our D1, our D2, our D3, our D4, and then we have the what here? Somebody? D5, isn't it? So is there some? No. We shall overcome. We shall overcome. So is there somebody who is able to remind us the formula for getting growth rate? Growth rate, anybody? Yeah, we said growth rate will be the current dividends all over the very oldest dividends. Dividends. And then we talk of what here, somebody, nth root. Do you remember that? Nth root. And then whatever we shall get, we shall come and say less what here, somebody? You less 1. Whatever we get, we say we get less 1. So KA, where are we getting this 3.7? Look at note number 3. Note number 3 is wrong. It is reading current earnings per share. I wanted current dividends per share. Thank you for asking that question. The current dividends per share is how much here? I was very wrong. I was very wrong. It's supposed to be dividends per what here, somebody? Dividends per share. Sorry for that. 2.7. Even that growth rate was absurd. Absurd. So in this particular case, what is our N? Our N, you go with this, 5, Our N is 5. Or you count like this, 1, 2, 3, 4, 5. Or in this case, if you want to say that they are 6, then we say 6 minus what? 6 minus. But the very best is always to number them like this. And then you know that this 5 is your N. You'll never go wrong that way. You'll never go wrong that way. So we're talking of fifth root of the current dividend is 2.7. All over the oldest dividend. Oldest dividend is 1. What here, somebody? 1.5. And then whatever we shall get now later, we shall come and less who? Less 1. Then we remember we said there is a possibility that some students don't know how to get the fifth root. Some students don't know how to get the fifth root. If you don't know how to do that, you can come and say 2.7 divided by what here, somebody? And then you raise this to what, if you're able to remember? You raise this to 1 over 5. And then whatever you get now, you come and less 1. Actually, this is a very, very good method. So you'll be able to come here and I say, I'm raising it 1/5 because of the nth root. So I'll come here and I say open brackets, 2.7 divided by 1.5, close. Then we say raised to. In your calculator, raised to looks like this. In your calculator, there's a button. So you say 2.7 over 1.5 raised to, always open brackets for the power. Always open brackets for the power. So raised to 1/5, you close. Equals, whatever answer you get, you say -1. Whatever answer you get, you say -1. J is giving me a figure of 0.1247. 0.1247, which is the same as 12.47 watt/%. You can either use the fifth root or you do it this way using 1/5 raised. So remember, if you are adopting this approach, if they told you seventh root, I would have said 2.7 over 1.5 raised to 1/7. Don't forget that. Don't think that 1/5 is the formula. Because the next time they'll give you 4 or something. Yes. Not 2 years. Very good question. Yes. What about them, right? So there is a note there talking about, I like such questions, talking about those two. Rona Restaurant Limited estimates that what your free cash flows. Will that really come here? No. That's a different method of valuation. Free cash flows, we shall be able to do that free cash flow table. We discount them present value. That's a different method. Here we are using a very different method. They have told us in this particular question, they want us to use dividend growth model, which is the Gachagwa's model, which we are doing here now. We are getting what we call the growth rate. I hope I've answered you. Yeah. So kindly explain the other one that we normally use, n-1. So please repeat on how to raise the power. So the one where we use n-1, how many years do we have here? 1, 2, 3, 4, 5, 6. Then you would have said 6 minus 1, which would have given us what here, somebody? 5. So it comes down to the same thing. Comes down to the same thing. But if you start numbering them from DO, you'll always know your n. Your n will be the last digit here. Your n will be your last digit. So because if you're using the n-1, then the number of years here are 6. 1, 2, 3, 4, 5, 6. So you'd have said 6 minus 1. It will give you the same. The online ninjas, are you able to agree that it will give you the same answer? These online ninjas, yeah. Then please raise how we raise the power. It's very easy. Are you able to see this raised? Raised to, are you able to see it? This raised to, if you're able to see it, then use your brackets very well. You say open brackets, 2.7 divided by 1.5. No more divide. You close. Then you say raised to. If you're using this raised to, ensure to put the power into brackets. If you don't put this power into brackets, you'll always be wrong. So you say 2.7 divided by 1.5. Then, of course, they're in brackets. Raised to, open brackets, 1/5, close. Then you say equals. Whatever answer you get, you say -1. This less is -1. You'll be able to get that 0.1247. How did you get 2.7 for year 2022? Great. So remember, here for 2021, all the way 2021 moving back, they told us in note number 2 that those are past 5 years dividend. So the past 5 years dividend. And then they went ahead in note 1 to give you current dividend. So it means that the current year must be 2020. So note number 1, the current dividend payment per share is 2.7. So 2022 is the current year. All right. So then we are now good to go. We are good to go. So if you are good to go, ladies and gentlemen, this is what we shall do. To come here and get PO of duet. PO of duet. PO of duet. So then this one here will be DO into 1 plus G all over KE minus G. Remember this DO, don't be cheated and think that this DO is the very oldest. This means current. So when it comes to substitution in the formula, the most current dividend is what here, somebody? is 2.7 into 1 plus our growth rate. Our growth rate, I remember very well, it was 0.14. It was 1 point. Okay. We start again. 247. Thank you very much. How about the cost? Remember here, I can't use wakaka because wakaka, we use wakaka to value the farm. But you see now here, they want us to value a share. That's why they're telling us to use dividend. Dividend valuation model is for valuation of a share. And to value a share, we normally use cost of equity. So has the examiner given me the cost of equity? Has the examiner given me the cost of equity? Remember, cost of equity is the same as shareholders what a return? So the cost of equity, is there somebody who is able to see 0.25? Why they can't see that? Why they can't see that? They are not able to see that. There is somebody who sang and said in Kiswahili kwamba wana macho yote lakini hawaoni. Yeah, of course, you guys are able to see 15%, isn't it? But you see your value share of duet. And the duet, what have they told us in note number 1? What have they told us about duet in note number 1? That the investors of duet would want an extra return of what year? 10%. It is estimated that the shareholders of Duet Restaurant Limited require a return of 10% higher than that of Rona. So if Rona's cost of equity of Rona, if cost of equity of Rona is 15%, isn't it? Then cost of equity of Duet will be 10% plus what here, somebody? That's how I got 25%, which is the same as what here? 0.25%. How I wish in this case here, this examiner would just know that these students we are teaching, they are just but children, isn't it? How would they want to really now twist this grammar like this? That's very, very bad, isn't it? But we are overcoming, right? You're overcoming. But you must be able to know, when do we use WACC? We use WACC to value organizations. We use cost of equity to value a share. A share. To value a share. Now we have everything. So you do separately. You say 2.7 times, open brackets, 1 plus 0.1247, close brackets, equals. First of all, you must give us the numerator. And then for the denominator, you say divided by, open brackets, 0.25 minus 0.1247, you close brackets. You say equals. So I'm being given a figure of 24 point what here, somebody? 24.24. So this is value per share. Value per share. But now remember, they want us to give them the total farm value. Total farm value for someone to come and buy this organization. Total farm value. So you guys need to tell KASNEB we are children, isn't it? We are children. We are children. Total farm value. What do you think are we going to do to get total farm value? We shall take value per share times nose times number of ordinary shares. So it will be 24.24. Number of ordinary shares are how many? William alone. For Duet, we say they are 5 million, isn't it? For Duet, they are 5 million. The good thing is that they shall repeat these questions. They repeat them. That is a good thing. They repeat them. They're 5 million. Now, the question that the sister was asking here is in Roman 3. When now they want us to estimate the value of Duet using discounted free cash flows. So this one, they're giving me a figure of 121.2. 121.2 million. Is that okay? Thank you so much. 121.2 million. Thank you so much. Is that okay? Yes. I would rather you write it in full. 121, yeah, comma 200,000. Good question. Write it in full. Let's write it in full. This one here will be 121, 200,000 Kenya shillings. Thank you for asking that question. All right. So then we go to the last one, which is discounted free cash flow basis. And I would not want to answer that question. I would want to leave that question for you. You try. And ensure that you talk to somebody. Talk to somebody, talk to somebody, talk to somebody. Yeah, you must be having neighbors. If you don't have neighbors, then of course that means you are studying online. And if you are studying online, you have either a child, a spouse, or whoever that you can sit down and talk about this question. So for PVIF, do we still use 25%? No. No. Remember that is cost of equity. Now remember, three, we are now using the W what here, somebody? Because now we are valuing the whole cash flows of a firm that has got both debt and equity. Whitney, I don't want to talk about that. I want to give you 1 minute first. I want to give you 1 minute first. So this is really very easy question, easy peasy. I gave you enough time to do it. Easy, easy, easy. So in terms of free cash flows, what do we have there? So in terms of free cash flows, what do we have here? So in terms of free cash flows, year 1, year 2, year 3, they are telling us, ladies and gentlemen, in terms of free cash flows, what are they telling us, these people? Note number 2, Rona Restaurant estimate that the free cash flows from Duet Restaurant at the end of the first year will be 2,500. You can do this in shillings thousands, isn't it? And then these will grow at an annual rate of 5% for the first 4 years. So 5%, 2,500 times 1.0, is it 1.05? Which gave you guys what figure? 2,600. 26, 25. So then this will be 2625 times 1.05, because it's 5% every year. Every year. Or you can, how did you do it? I don't know. Like this, 2625. So 27, 56.25. 27, 56 point. And then year number 4, what do we have there? 27, 56.25, again times 1.05, isn't it? Which will give us what figure? 28, 94, 06. And then I can go to year number 5, and I have this growing when they tell us that the 5% growth rate will be for the next 4 years. If it's next 4 years, then I would have added those 4 to this one. I would have gone to year 5. But you see here they have told us that this figure will grow by 5% for the first how many years? 4 years. So up to year number what year? Year number 4. Thereafter, what happens? Thereafter, what happens? They are not talking to me. We revert to the historical earnings stroke dividend growth rate into perpetuity. So in this case here, we have our perpetual. So in this case here, the perpetual growth rate we calculated with you. Do you remember that G? It was coming to how much? 12.47%. 12.47%. 12.47%. I share screen. I share the screen. Why should I share the screen, Chelsea? Not unless you're not able to see. All right. So then are you able to now use this to give me the Gachagwa's cash flow? To give me the Gachagwa's cash flow. So the Gachagwa's cash flow, ladies and gentlemen, what do we have there? The Gachagwa's cash flow. What do we have there as Gachagwa's cash flow? As the Gachagwa's cash flow. The good thing is that you have tried this. What we shall do, ladies and gentlemen, we shall give you another assignment, which you should be able to do. Yeah, this one, out of December 2024. The trigger one, yeah, the trigger one. So we have here April 2022. April 2022. Question number 5A. So please ensure that you finish this to the very end. And then when we meet, you should also have done this April 2022. Question number 5, what year? Question number 5A, that is on Sunday. What time? Because I have another class, BDA, which is supposed to start at 8 p.m. So I need to run away. So remember Sunday, please don't miss for this revision. Sunday, 7 a.m. Yeah, to 8. Otherwise, thank you very much. See you then. Bye.